Repo fails are still rising, and they're being corroborated by a key Japanese market signal. Now, that ties in the yen carry trade, though this isn't specifically about that trade. It's instead about how US recession risk may be impacting global funding conditions. As far as most people are concerned, early August was a lifetime ago. The US economy has since shown itself to be epically resilient. A strong payroll number in September plus disinflation, that somehow equals Goldilocks. Yet from carry traders on out, that's not the perception at all. The fact that we're even seeing repo fails rise, for example, even though the Treasury is issuing monstrous amounts of Treasury bills, that's already a red flag. And it's often the lack of issuance which intensifies collateral problems, so seeing them here in spite of massive bill issuance is one thing. Corresponding with that is a unique Japanese market signal, and that's a completely other thing. And ironically, it's a Japanese government bill, too. Now, right now, this specific one is trading wildly below the Bank of Japan's overnight rate. And like when we see the US Treasury bill rate do the same thing, such as both in the middle of September, it's an unmistakable collateral sign. Why would anyone choose to hold a short-term government bill that yields so much less than other short-term money rates unless there is something valuable about the instrument itself? What people don't immediately get is the connection here. The 4-week Treasury bill and US dollar repo collateral, sure, get that, understand it. How does that get to Japan and Japanese government bills? Now, we'll answer that question here, and it's not all that really difficult. See, once you arrange the pieces properly, it's pretty easy to see and understand that what's really happening here is a lot more than just Japanese carry trading. It's about collateral, and we'll get into why that is and why it matters. Whenever we see these signals and indications, it tells us about fragility, something that we observed in a very short run space back in early August. Now, I mentioned all of this stuff, especially repo fails, on a live stream, and where we left off with was the rising trend in repo fails. They had been falling for a couple years there, coincident to Treasury issuing more and more bills and doing so in a dependable fashion. So the fact that we've seen repo fails break that trend and start to move higher, but more importantly, when they did in early August, that was already a signal saying maybe we should pay attention to what's going on in collateral. The latest data we got from the Federal Reserve Bank of New York, picking up where we left off on that live stream, we got fails going up again. What I talked about then was the high amount of fails at the end of the quarter. Last week in September, last full week in September, you had almost 400 billion in fails combined, which is an enormous amount. And then the same amount, almost 400 billion, almost exactly the same amount, the last week in September, getting into the first week in October. Then fails fell back as we expected the first full week in October, before jumping back up to nearly 200 billion in the latest data, which was the middle of October. That brought the 8-week average up to 253 billion, which is the highest since last year. So you could see that what we're seeing since early August is a continuing rise in repo fails. And that has corresponded with a drop in the 3-month Japanese government bill rate. And this is a validated signal that goes back quite a long ways. So what we see in the Japanese government bill rate is that it's below the overnight rate in Japan, which is set by the Bank of Japan. It had been rising since around January this year. It even got to be above the Bank of Japan's overnight rate at 0 before the Bank of Japan raised rates to 25 basis points on August 1st. But that's where we start to see everything go in a different direction. The 3-month bill rate was only about 15.6 basis points on August 1st, then stayed at that level on August 2nd, even though the overnight rate had jumped to 25 basis points. So already we're seeing the signals that suggest an unusual amount of demand for 3-month Japanese bills. And by the end of September, the 3-month Japanese bill rate was down to 3.5 basis points, and it kept on going, getting all the way to just about 0 around October 8th. And since then, including last week, it's been very close to 0, well below the 25 basis points that the Japanese Bank of Japan has set for the overnight rate. So heightened demand for specifically the 3-month bill that isn't explained by comparisons of investment alternatives. Why would you accept a 3-month bill rate at 0 when the overnight call rate is 25 basis points and other money market rates are in the similar range? So, okay, we got the Japanese government bill rates that go below the overnight rate. Shows that there's Extraordinary demand for this particular instrument. But what does that have to do with US repo fails and collateral and US dollar funding? Now, since we're talking about Japan, it seems like there has to be something with a carry trade, and that's there. So let's imagine that we are Japanese carry traders, and we're funding our carry trade positions in US dollar repo. So we have US dollar denominated assets that are funded in the repo market. And say we're owning US junk collateral, US junk bonds, because we're reaching for yield. We want to enhance our returns. So we're actually doing some kind of collateral swap where we swap the junk collateral for treasuries and then go into the repo markets for funding. Probably some CLOs or some other crappy stuff. Doesn't really matter. But there's a couple different legs and a couple different pieces that are on the board here. So if something happens that makes US dollar funding more difficult, where it's more difficult for us to acquire collateral, so we own a junky CLO and we can't swap that for a US Treasury, suddenly we have more difficult funding terms for us. We have an option. If US repo and collateral becomes difficult, it becomes scarce to swap into US Treasuries because Treasuries are not circulating the way they did before, we can swap our yen for scarce US Treasuries. And we do that by borrowing in the FX markets instead of repo. Now in FX, we're still borrowing US dollars. Remember, we're the Japanese carry traders, except here, when we swap for US dollars, we're swapping yen as collateral. So the US dollar lender is lending us US dollars and we're providing them yen on the other side of the swap. So it's as if the yen becomes the collateral that we post in the same type of funding arrangement. But now the US dollar lenders have that yen, they choose to hold that yen or invest it in some other liquid investment like Japanese government bonds and bills. And US lenders don't care about the return on the yen asset. They're making their money on the swap, especially since this tends to happen during funding periods where we experience funding difficulties, which means there's a premium to lend US dollars to Japanese and other counterparties around the world. So the US dollar providers are making extra return lending the dollars, and then they take the yen that they get in collateral and buy, for example, 3 months Japanese bills. So when we have US Treasury funding difficulties, collateral shortages, it doesn't circulate in the way that it does before. We see rising US dollar repo fails. What happens is Japanese reroute their borrowing from repo that becomes more difficult into FX. And when they swap into FX, it's like they're swapping the collateral that they're posting to borrow US dollars. Now, this is another topic that I went over in great detail in our deep dive analysis, which is what I aim to do there. To really go deep into the mechanics, the background, and the motivation so that we can figure out what these signals are really telling us. That's what Eurodollar University is for, to move beyond conventional wisdom, to challenge these widely held misconceptions on money and macro. And right now we're at the very end of our fall sale, the last couple days in it, and that features our best prices on all our products that help you get to the bottom of what's going on right now, to give you the necessary and badly needed background behind all of it. And all the information, the daily briefing, the deep dive analysis, and the memberships, that's at our website, eurodollar.university. And this isn't something, obviously, that just showed up over the last couple months. This has happened repeatedly going back to 2013, believe it or not, in the immediate aftermath of QE number 4 in the United States. And yes, there were 4 QEs, actually probably 5, but at least 4 QEs up until 2012. The 4th QE was the Fed targeting US Treasuries. And specifically in early 2013, the geniuses at the Fed were buying on the run US Treasuries as part of QE4 that created some difficulties in US dollar repo. And suddenly we see the first instance where the Japanese 3-month government bill takes a notable detour from its previous trend. And I talked a lot about this, more detail at the deep dive analysis. For here, our purposes here, just note that that's the first indication that something was going wrong. And it happened again, another one that I talked about in the deep dive analysis, October 2014, really September into October 2014, when there was a buying panic in US Treasuries on the 15th of October, which the Fed and the government said was computer trading in Treasuries. What crap that was. Essentially, you had a collateral scarcity leading to a panic buying in US Treasuries, and you see an impact in Japanese government bill yields. And we should note that the 3-month Japanese rate is trending lower, especially since the middle of 2013 because of QQE. But that doesn't explain these obvious deviations. That's more about the trend moving down closer to zero and then getting a little bit underneath it. So the constant buying of Japanese government bonds by the Bank of Japan, creating more bank reserves that Japanese banks have, and therefore they use to own Japanese bills in the same way that US dollar lenders are doing, but for very different reasons. And it's a more uniform trend. When we see that uniform trend break, that's this thing that we're talking about, such as the big one, March and April of 2016. Yes, we keep coming across March and April, especially the middle of March, because we're talking about bottlenecks. We also see this, by the way, in the middle of September too, as I'll get to in just a second. So there's bottlenecks involved. There's US dollar collateral, repo, and this connection to Japanese bills. And if you think about March and April of 2016, you see that huge abrupt drop in the 3-month bill rate. And at the same time, in fact, just before that, we had a massive outbreak of US dollar repo fails. In fact, it was huge. The week of March 9th of 2016, repo fails exploded to 889 billion, which was the highest since the worst of the 2008 crisis. And then it kept up in the following week, March 16th of 2016, 873 billion. Again, the mid-March bottleneck. And then we saw again another big jump in fails in the middle of September, the bottleneck there. The week of September 14th, repo fails in US dollar terms up to 685 billion. And then there was another one in the middle of December. So 2016, a year that was plagued by funding difficulties all over the world, especially related to China and Asia, Tokyo, Japan, all of that stuff. Massive amounts of repo fails that rise at these really the bottleneck parts, the middle of March, middle of September, and the middle of December, where you get another 832 billion in repo fails. And that corresponds, those repo fails, almost exactly with the behavior in Japan's 3-month government bill. So you see the 3-month bill start to go down in the middle of March, but then it makes a huge move in early April, just indicating that the eruption of repo fails was just the start of the collateral difficulties in US dollar terms, and that Japanese firms were increasingly turning to the FX market, and therefore they were borrowing dollars in FX, swapping their collateral they post to yen from US Treasuries, meaning that US dollar lenders ended up with yen and therefore parking that yen in 3-month bills. Even though they were yielding exceptionally negative levels, the US dollar providers don't care because the amount they were charging to lend dollars in FX was enough of a return for them. You see the same thing continue in the middle of September. On September 1st, the 3-month Japanese bill was minus 24.5 basis points. That declined to minus 36 basis points as of September 16th. So right when repo fails start to skyrocket yet again. Same thing in later November. 3-month Japanese bill rate on November 17th was minus 26.6 basis points. Got down to all the way to minus 47.3 in the middle of December and would stay that way till the end of the year. So there's a very strong correspondence between repo fails, collateral difficulties in US dollar terms, and Japanese bill yields. I do want to briefly mention a couple other that I went over in the deep dive analysis too, a couple other periods when the government bill rate goes down, collateral difficulties, that kind of thing. October of 2018, right from the beginning of October 2018, during what we call here Eurodollar University, the landmine, big trouble, US dollar junk bonds, CLOs, that type of thing, collateral indications there. See a sharp drop in the 3-month bill rate from minus 12 basis points to 32 basis points. And then another one again in 2019, September 2019, the repo rumble. 3-month bill rate goes down a little bit. It had been above the Bank of Japan's overnight rate. Goes down a little bit August into September, and then a big drop after all the stuff in the US dollar repo market. Really right at the end of the quarter, huge drop in Japanese government bill yield, suggesting same type of collateral difficulties. More recently, 2022, the middle of 2022, the June bottleneck there, and then September of 2022. While everybody's talking about the UK and the gilt market, swaps and a whole bunch of funding indications, including the Japanese 3-month bill rate, suggesting US dollar collateral, all of that stuff. Big drop in the bill rate, Japan bill rate in September of 2022. And again, March of 2023, just a little bit before Silicon Valley Bank, as we see all sorts of collateral problems go on there too. So it's a historically validated connection between US dollar repo, collateral, and how it goes through Japanese financials into this rerouting, reborrowing into FX markets from repo. So problems in repo become greater demand for FX, therefore swapping yen as collateral for scarce US Treasuries. And the fact that we're seeing this again, rising US dollar repo fails since early August, same time we're seeing the Japanese government bill yield go down from early August into October, that tells us not just that there's collateral difficulties, we knew that, but they're still ongoing. And since all of this is tied, as I mentioned on that live stream, to US recession risk, the further fall in Japanese, the 3-month bill rate, tells us that the carry trade is still being unwound, which we know. There's still difficulties in US dollar repo and collateral, which we know, and that it's still going because the participants in all of this are thinking, whatever everybody's saying in the mainstream, we're not seeing a lower US recession risk. In fact, as I pointed out on that live stream, I do want to point this out again. Mizuho Financial is preparing for short-term market disruptions if investors' predictions of a soft landing in the US prove wrong, by stocking up on easy-to-sell assets or repo assets such as US Treasuries. In other words, they don't want to get caught having to do this backdoor FX because it's expensive. Now, that's one reason why they're borrowing in repo to begin with. The only reason they go into the FX market as a workaround is because they can't get the collateral they need in the US dollar repo market when collateral becomes scarce and it doesn't circulate. So what they're basically saying here is, we're just going to buy the treasuries anticipating that if all of the stuff that happened in early August happens again, we won't have to go into the FX market and have to pay exorbitant rates to borrow in FX because that's the only option we have. We'll just stock up on the treasuries now. That way we have the collateral, we have the instruments. So if we have to sell the treasuries to raise funds, we can do that. If we have to use the treasuries as an alternative method to borrow in repo markets, we can do that. We're not going to be left to, like early August, to some undesirable alternatives, which is what we're really talking about here. So we've seen a modest rise in US dollar repo fails. Not anything huge, but a noticeable change in trend, and it started in the early part of August. That's what really catches our attention. That has been corroborated by a number of indications, including the behavior, especially late August and early in the middle of September, of the US Treasury bill 4-week rate. That plummeted, suggesting very sharp collateral scarcity and shortage at that time. Through it all, we've also seen, we've heard about the Japanese carry trade. The carry traders themselves have suggested they're still not sanguine about U.S. recession risk. Even if they don't necessarily believe the U.S. is heading to a recession, they don't want to sit around and wait to find out. So they're unwinding carry trade positions, doing so in more careful and orderly fashion than they had done in early August. And that has involved some knock-on effects, lower quality collateral being repriced and reevaluated. Treasuries aren't circulating apparently the way they did before, forcing some Japanese carry traders to instead swap U.S. Treasury collateral that maybe they're borrowing for Japanese yen collateral that they have tons of access to through the FX market. So as US dollar repo becomes more difficult, especially collateral circulation, higher use of FX, more demand for Japanese government bills. That's what we've seen continuously since early August. And so while everybody says the US recession risk is done, it's gone, soft landing forever, the marketplace itself, this key part of the funding markets, does not buy into it. And so that is something to watch, as both a warning about the U.S. recession possibilities and therefore the global consequences, but also, as we saw in early August, we got a window into the potential fragility if we have more of a widespread awakening to what is a more than macro risk. This is about money and collateral too. If you want the background on the US dollar repo fails part of it, that's what I went over in that live stream. And the replay of it, I've got a link below here. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out our fall sale. We're in the final days there. And until next time, take care.